The performance and growth of real estate companies are essential for the economy's health overall. Real estate companies play an important role and are a major source of employment, investment, and tax revenue. They are important in developing and maintaining the country's infrastructure. In this video, I will explain internal and external factors that impact the performance and growth of real estate companies and analyze correlations among them. The impacting factors. The impact of a company's performance and growth factors on corporate performance is extensive. However, a limited amount of research has been conducted specifically in the context of the real estate sector. Internal factors such as size, cash holdings, profitability, and leverage can impact real estate companies' performance and company growth. On the other hand, performance and growth can also be driven by external macroeconomic factors such as GDP growth, foreign investment, interest rates, and government policies impacting the sector.
Internal factors. First, size of the company. Large real estate companies usually have more resources and economies of scale, which leads to better deals for investors and clients. In addition, those real estate companies may have brand recognition, which people and clients like and trust. Second, cash holding and equivalence. Real estate companies with more liquidity and higher cash reserves can take advantage of new investment opportunities faster, especially when purchasing real estate deals. However, liquidity also helps in risk management, such as the ability to stand longer in the face of market downturns and not distress sales of properties. Third, profitability. Profitable real estate companies can reinvest their earnings into property development and acquisition opportunities to progress their growth and enhance their performance. Profitability also attracts more foreign and local investors, improving their valuation and increasing their capital. Fourth, leverage. Real estate companies can leverage their capital structure, meaning that they can use debt to finance property acquisitions and amplify returns on equity. The higher the leverage, the more investments in more desirable properties, leading to increased returns. However, this can also introduce risk if property values decline.
External factors, macroeconomic factors. First, GDP growth and demand for real estate in a growing economy normally leads to increased job opportunities, rising income, and higher consumer confidence, amounting to a higher demand for the real estate market, both residential and commercial, to buy and lease properties for more people and businesses. Second, foreign investors can contribute to answering the demand for real estate, especially in high-demand areas, and drive up prices in desirable markets. Third, government policies such as reducing taxes and restrictions can help influence foreign investors and make real estate more attractive to invest in, besides higher demand. Diversity by foreign investors through the local market can also introduce new trends in demand. Fourth, higher interest rates can make mortgage costs more expensive to borrow for real estate, leading to reduced demand. Conversely, lower interest rates will stabilize it and stimulate demand. Interest rates also influence the cost of capital for real estate companies, reducing and impacting their profitability and forcing them to have higher leverage, affecting and harming their performance in real estate. Mortgage conditions, such as tax incentives or buyer tax factors, can influence housing affordability and demand. However, government investment in infrastructure projects can lead to and create opportunities for real estate and hike up property values in some areas. Nevertheless, the sector faces several challenges, such as high interest rates and bureaucracy.
The correlations between internal and external factors can impact real estate companies and their strategies either in positive or negative notions. The obvious correlation is when a company's internal financial health can form its responsiveness to external ones. For example, companies with strong profitability and cash flow are better positioned to capitalize when interest rates are low. Conversely, a decline in GDP growth can lead to lower demand and profitability, and the cash constraints will affect and impact a company's growth strategy. Another example of internal and external factor correlations is between leverage and interest rates. The higher the interest rate, the more companies with high leverage will face financial strain, leading to reduced investment or selling properties to compensate for cash flow issues. Several factors can impact the performance and growth of real estate companies. These include company internal factors such as size, cash holdings and equivalence, leverage, and profitability. External factors like GDP growth, Government policies, interest rates, and foreign investment will impact real estate companies. The correlations and interplay between internal and external factors are crucial to understanding real estate and business performance and growth. Companies that can effectively manage their internal resources and adapt to changing external economic conditions can better suit their position for good performance rates and sustainable growth. Squarecom, thank you. This YouTube channel is about business management in general. The sole purpose of my articles and videos in business is to educate and be educated. Squarecom. The videos and short tubes are about business management, finance, management strategies, and business management functions. Read more articles and stories from Squarecom on Medium and LinkedIn. Please leave any comments or suggestions you may have. I would be delighted to receive them at any time. If you enjoy the video, kindly give it a few applauses, like and subscribe. Feel free to share my articles and videos at any time. To all of you, happy day or night.